Let's talk about your 401k, specifically how to protect your hard-earned retirement savings when the market gets, well, a little wild. I know it's a topic that can cause a ton of stress, but trust me, with the right strategy, it really doesn't have to.
You know that feeling, right? When you're anxiously checking your 401k balance during a market dip? Yeah, if you've ever done that, you are definitely not alone. The ups and downs are a totally normal part of investing, but that doesn't make that sinking feeling in your stomach any less real.
But here's the good news. You're not just a passenger on this roller coaster. There are real, concrete strategies you can use to manage that risk. You absolutely have the power to build a 401k that lines up with your own comfort level, giving you stability and, most importantly, peace of mind about your future. So, where do we even begin? Well, the first and honestly the most crucial step is to find your own financial compass. This isn't about what your buddy at work is doing or what some expert on TV is shouting about. It all boils down to one simple thing: your personal tolerance for risk. And think about it, this totally makes sense, right? Our goals change over time. When you're young and retirement is way off in the distance, the main goal is growth. So you can usually afford to take on a bit more risk. But as you get closer to actually needing that money, the mission shifts to preservation. You just want to protect what you've worked so hard to build. And that brings us to a really key point. You are in the driver's seat here. Most 401k plans give you a bunch of options to choose from, usually somewhere between 8 and 12. And you can, and probably should, adjust your investments as your life and your comfort level change. It's your plan, and you have control. Just check with HR to see how often you're allowed to make those changes. Okay, so let's get practical. Think of your 401k options like a toolkit. If your main goal is stability, you need to know which tools are designed for that specific job. So let's open up that toolkit and look at the most common low-risk options you'll find. First up, we've got bond funds. Now, instead of buying a piece of a company like you do with a stock, with a bond, you're basically lending money to a government or a corporation. Because they're built on debt, they're generally seen as a much more conservative choice than stock funds. So the huge plus for bond funds is stability. I mean, some options, like Treasury inflation-protected securities or TIPS, are about as safe as it gets. But there's always a trade-off, right? The returns are usually going to be more modest than what you might see in the stock market. You're basically trading that high growth potential for consistency and a good night's sleep. All right, next in the toolkit is the money market fund. The entire purpose of this fund is to keep a stable value. It's designed specifically to try and keep its share price from dropping while also making sure your money is super easy to access. The keywords here are high liquidity and minimal risk. It's pretty much one of the safest places you can park your cash inside a 401k. But just like with bond funds, that safety comes with a catch. The returns are usually going to be on the lower end of the spectrum. Now for a really popular one, the index fund. This is all about passive investing. So instead of trying to outsmart and beat the market, an index fund just aims to be the market. It does this by tracking a big index like the S&P 500. And just like that, you get instant diversification across hundreds of companies. That diversification is its biggest superpower. You're not putting all your eggs in one basket. And this is a big but, it's so important to remember that because it tracks the market, it's going to go down when the overall market goes down. It's diversified for sure, but it is not immune to volatility. Now here's an option you might not have heard of, a stable value fund. This one is really interesting, especially for the super risk-averse investor. Think of it as a conservative bond portfolio that comes with its own insurance policy, one that guarantees your principal investment and provides steady interest payments. And that guarantee, that's the whole ballgame here. Your principal is protected. The returns you get are typically a little bit higher than a money market fund, but still lower than what you'd expect from higher risk investments. It's a really powerful tool if your main goal is just preserving your capital. Okay, so we've looked at all the individual tools in the toolkit, but what if you're thinking, I'd rather just have a more hands-off approach? Is there an all-in-one solution? You bet there is, and it's a really popular one. It's called a target date fund. And the idea is brilliant in its simplicity. You just pick a fund with a date closest to when you think you'll retire. And that's it. It does all the rebalancing for you. As you can see, it starts out more aggressive with mostly stocks when you're young, and then it automatically gets more conservative, shifting more into bonds as you get closer to that target date. But, and you really need to hear this, even this automated approach is not completely risk-free. While it's designed to lower your risk over time, the income you get from a target date fund is not guaranteed. It's a fantastic tool, but it is not a magic wand.
All right, we've figured out our financial compass, and we've looked at all the different tools in our low-risk toolkit. So now what? How do we put all of this together? It's time to take what we've learned and actually turn it into action.
But before we get to the action plan, let's just repeat the number one fundamental trade-off of all investing. If you want higher potential returns, you usually have to take on higher risk. It's the name of the game. Okay, let's put it all together.
So here it is, your simple 4-step action plan. First, just log in and actually look at the investment options your employer offers. Step 2, be really honest with yourself about your personal risk tolerance. Where do you stand? Third, make the adjustments so that your investments actually line up with that comfort level. And finally, number 4, make this a regular thing. Revisit your plan every so often because your life changes and your plan should probably change with it.
Because at the end of the day, all of these strategies and tools are really just designed to help you answer this one simple question. For you, is it about maximizing growth no matter what? Or is it about being able to sleep soundly at night, knowing your hard-earned money is safe? Figuring out what your own financial peace of mind looks like, that's the real key to safeguarding your future.